Good afternoon, everyone, and welcome to the second to last installment of the Loan Vision Industry Insights webinar series. It is a miserable, rainy day here in southwestern Pennsylvania, and so I am joined by Santo Schiarelli and Frank Erco of ACS, who are going to brighten it up with some interesting stuff on navigating the PPP loan forgiveness application for lenders. If you don't know me, I don't know how. I'm Jordan Pavelka, and I'm the Marketing Communications Manager here at Loan Vision. Our presenters today, like I said, are Santo and Frank. As an accounting and auditing partner at ACS, Santo is responsible for the Mortgage Banking Service Division and has been for the past 30 years. Frank is a senior accountant in the tax department, and he has experience handling a wide array of tax matters, including tax returns for both small and large businesses. Santo and Frank, how are you gentlemen doing today?
Doing well.
Great, thank you.
Doing great, thanks.
Good to hear. Before we jump in, I do have a couple of quick housekeeping items. We are indeed recording today's call and will be sharing it to all registered attendees. All attendees are also muted, but we do want this to be interactive. So if you have any questions, you can send them to us at any time via the Q&A box, and we'll have a question and answer session at the end of the demonstration. And without further ado, I'm going to hand it over to the experts, Santo and
Okay, well, first of all, Jordan, thanks very much for having us give the opportunity to present this important agenda today. And myself and my colleague Frank will do all that we can to make it as interesting as we can. Brightening up the day, I'm not so sure that's going to work, but we'll do the best that we can. So,
Santo, you always brighten up the day, please.
Thank you. That's why I love you, Jordan. So, all righty. So we're going to start by, we're going to talk about the agenda. I'm going to go through the agenda that we're going to work with today. We're going to talk about the certifications that were made in good faith on the PPP application. We're going to discuss documenting the economic uncertainty at the time of application, including the state of the industry at the time. Were IMBs eligible to receive the PPP assistance? We'll have a discussion around that. We'll talk about preparing for the PPP audit forgiveness, which myself and my colleague Frank will have do most of the presentation on that. How we're going to get ready for the preparation of the forgiveness. We'll talk about some proposed and passed legislation, as well as going through the forgiveness forms, calculations, and talk about the accounting treatment of the PPP loan, as well as the tax treatment, and when we should strategically file forgiveness applications. So without further ado, we will get started. Question, should I be concerned with the current economic uncertainty certification that was attested to in the loan application? Well, this is something that needs to be documented today and not in the future. We believe that mortgage bankers certainly did qualify for this economic uncertainty, given the state that the industry was in during March and April of 2020, all of which were detailed in industry publications, which include decrease in aggregated pricing, significant margin calls, diminishing pipelines, hedging losses, major increases in decreases in servicing values, all contributed to liquidity and future uncertainty within the industry. How is the liquidity determined for good faith PPP applications? Well, it was strictly subjective. I believe a cash forecast should be prepared to be audit ready, outlining broker dealer margin calls as well as the decrease in aggregated pricing. Obviously, this is really for loans that were in excess of $2 million. I believe that's going to be the ones that are going to be heavily scrutinized, but we'll get into later on who's responsible to go over the application and actually approve the forgiveness of the funds. So within the regulations and the SBA regulations, there was something in there which basically could have, could present a problem with IMBs receiving the funds or being eligible to receive the funds. There was a in the SBA SOP 50 subpart B, a mortgage company that disperses loans and sells them within 14 calendar days are eligible to apply for the PPP loan. But we also knew, given the circumstances that occurred around that time, that the 14 calendar day rule could be pretty difficult. Some of my colleagues said that this rule really doesn't apply. I think it may apply, especially, so just wanted to make a note of it and to be ready in case you get questioned on it. We have been advising our clients to obtain dwell time reports from their warehouse lenders, as well as Encompass or whatever loan origination software that they use for specific periods to support the 14-day average. I think if you're able to show an average of 14 days within a couple of specific periods during the year, that should be pretty much satisfactory. But any institution that originates, disperses, and sells loans in greater than 14 days are not supposed to be eligible for this loan, and also mortgage companies that portfolio loans, or any financial service companies that portfolio loans as well. So it says, will bankers, lenders be the sole decision makers of the PPP loan amount to be forgiven versus the SBA? And the answer is yes. Your banker who originally you applied for the PPP loan, they're ultimately going to be the ones that will be giving the nod as to will it be forgiven or not. If you are not happy with their decision, I have been told that you can appeal the decision directly with the SBA, but I'm not sure about the specific process in doing that at this time. As we recall, our lenders had various definitions on what expenses were to be included in calculating the amount of the PPP loan. So this should be challenging, being forgiveness ready by having the right documentation and being proactive in preparing that documentation, which will be critical. In the beginning, it was a lot of uncertainty as to should the payroll taxes be included, federal taxes, and so forth. So each lender had their own, their own definition, if you will. So that presented some challenges to our clients as well. So we're going to talk about a little bit of the proposed legislation. The HEROES Act proposed by House Democrats, September 28, 2020, basically looking to extend the Paycheck Protection Program, have the second round of funding for small businesses with 25% decrease in revenue. I know that's more likely than not going to apply to this industry, but just to mention it. Allow for deductibility of forgiveness related PPP expenses. Also, the continuing Small Business Recovery and Paycheck Protection Program Act, proposed by Senate Republicans in August 2020, is discussing the second draw PPP loan for business with 300 or fewer employees and 35% revenue decline as opposed to 25%, a new loan maximum of $2 million, and allow additional categories of expenses for forgiveness. So with that, I am now going to turn the presentation over to my colleague Frank, we'll discuss the past legislation as well as the loan forgiveness applications and all of the tricks of the trade in preparing and getting ready for loan forgiveness. Frank?
Thank you, Santo. Good afternoon, everyone. My name is Frank, and I'll be talking to you today about PPP loan forgiveness. So you just got a good look into the proposed legislation, but now let's take a look at where we actually stand today. Here are two of the new legislative acts passed by Congress and signed into law related to COVID-19 relief. The first is the CARES Act, which created the Paycheck Protection Program. Eligible businesses were able to apply for loans that were equivalent to 2.5 months of their payroll expenses. Here you see the original rules, where employers would then have 8 weeks to pay out the loan funds in order to receive full forgiveness. The loan funds were based on 10.8 weeks of payroll, and you could then spend the money on 8 weeks of payroll plus other costs like mortgage interest, rent, and utilities. The caveat is that businesses must spend at least 75% of the funds on payroll for full forgiveness, and they must restore their headcount and salaries to pre-pandemic levels by June 30th, 2020. Those are now the old rules. The PPP Flexibility Act loosened up many of these restrictions. The PPP Flexibility Act provides further guidance on forgiveness, much of which we will cover today. The Act extended the period in which companies can apply for loans, so companies who missed out in the first round were able to apply for COVID-related relief through this program. That's now closed, though, as of August 8th. Important provisions of the PPP Flexibility Act include the following 3 points. The covered period is now extended to 24 weeks. The payroll expense floor is lowered to 60%, and the date to restore the headcount and salary levels was pushed back to December 31st, 2020. We will dive deeper into how all of this affects your loan forgiveness applications. However, on a higher level, what does this mean for businesses? It means there's still time to act and adjust before your loan forgiveness periods close. Virtually no one's 24-week covered period is closed yet, and everyone still has until December 31st to restore any deficiencies in headcounts and salary levels that may negatively impact loan forgiveness. Throughout this presentation, I will explain how your loan forgiveness is determined and then discuss how businesses can prepare and adjust to ensure their maximum PPP loan forgiveness. So I'm not going to go too much into the loan itself since the loan program is closed as of August 8th, 2020. Anyone who received the loan already has it. Anyone who has not received the loan is probably not going to get it, barring new legislation. So the focus of this webinar today is how to have these loans forgiven. Let's start with expenses. Which expenses qualify for forgiveness? There are 4 major categories that the forgiveness forms allow you to consider: payroll costs, mortgage interest, rent and lease payments, and certain business utility payments. The largest category will be your payroll costs. These include employee salaries, hourly wages, tips, and commissions paid during the covered period. As I mentioned earlier, the period in which to pay these expenses has now been extended to 24 weeks after receiving the loan. You can spend up to $46,154 on each employee during the 24-week covered period, which is a 24-week proration of a $100,000 annual salary. For many businesses that did not see significant layoffs, this means full forgiveness should be relatively easy to achieve. Now, payroll must only comprise 60% of the forgivable expenses. The non-payroll costs include mortgage interest, rent and lease payments, and certain business utility payments. The mortgage itself cannot be used for forgiveness, but the interest paid during the covered period on mortgage obligations incurred prior to February 15, 2020 can be used in the calculation. The same is true for business rent and lease payments made during the covered period, as well as business utility payments. These all must have been obligations and services that were incurred or began prior to February 15, 2020. Business utility payments can be expanded to include electricity, gas, telephone, internet, and certain transportation expenses. The period to spend is 24 weeks. Loans were funded off 10.8 weeks of payroll expenses, which would be your 2.5 months, the calculation you used to get the loan. For this reason, forgiveness will be easily achieved by many. The caveats are still there, such as the 60% payroll requirement. However, under the PPP Flexibility Act, full loan forgiveness is much more realistic. Given how much the payroll expenditure requirements have eased up under the PPP Flexibility Act, many of the companies that we've worked with will achieve full forgiveness without even considering their non-payroll costs. For example, one mortgage bank we have analyzed received a loan of about $2 million. To date, through their covered period, they've spent over $4 million on payroll alone during the 24-week covered period where they can spend out the funds. Therefore, they'll see maximum forgiveness without even listing the non-payroll expenses on their loan application. I know at this point I've used the term covered period a few times already, but let me formally explain what that means. The covered period in relation to the PPP loan is the 24-week period beginning on the PPP loan disbursement date in which companies must spend the funds in order to receive forgiveness. This has been expanded from the original 8-week period. The covered period cannot extend past December 31st, 2020, and 24 weeks equates to 168 days. So for example, one company we work on received their loan on April 26th, 2020, and their covered period would then end on October 11th, 2020. And then just for reference, today would be the last day of the 24-week covered period if you got your loan on April 15th. The form also allows for an alternative covered period, which may be administratively easier for some eligible borrowers. The alternative covered period is still 24 weeks. However, it gives borrowers the option to start their covered period on the first day of the first pay period following the loan disbursement date. This election is available to borrowers who operate on a biweekly pay period or more frequently than that. If you're bi-monthly or monthly or less frequently, then you would not be eligible for this alternative period. The election is made at the discretion of the borrower on the loan forgiveness form. While it's not necessary, this election does make it easier to calculate certain required aspects, such as compensation paid during the covered period, as well as the employee headcount, since there will not be any short periods to consider. There's no other tangible difference between the covered period and the alternative covered period. So for the remainder of this presentation, when I say covered period, I'm referring to both the covered period and the alternative covered period. All right, so you're a borrower who received the PPP loan funds and then subsequently spent out all the funds and then some on your various covered costs. What do you do now? It's time to figure out just how much of your loan can be forgiven. At this point, I've mentioned the term loan forgiveness about 100 times, but let's look at what I exactly mean when I say that. These are the targets we aim to hit when we spend the PPP funds. Loan forgiveness will ultimately be the lesser of the following three amounts. One is your initial PPP loan amount. This should go without saying, but if you have a loan for, say, $2 million, then the most you can have forgiven is $2 million. Obviously, you can't get more forgiven than the loan amount itself. The second limit is your eligible payroll costs divided by 60%. As mentioned earlier, the PPP Flexibility Act asserts that you must spend at least 60% of your forgivable costs on payroll. To calculate this, you would divide your payroll costs by 0.6 in order to determine your maximum forgiveness. For example, if you spent $600,000 on payroll costs, then your maximum forgiveness would be $1 million. The third limit is the most complicated one and what we will mostly focus on during this presentation. This is the sum of the covered costs reduced by any drops in employee pay and reduced by any drops in employee headcount. This is a confusing concept and the part of the forgiveness application that takes by far the most time. We're going to spend the next few minutes unpacking what all of those terms mean, how we calculate any drops in salary and headcount, and how these relate to your loan forgiveness. Which form should you prepare? There are two forms a borrower can possibly complete and submit. There's the Form 3508 and the Form 3508EZ. The borrower wants to fill out Form 3508EZ whenever possible. This form is much less cumbersome and will take much less time to complete when compared to the long form. Since the borrower is responsible for the preparation of the form, you want to be in a position to use the Form EZ. However, only certain filers can file that EZ form. So there's three criteria that you must meet in order to file this form. Criteria number one is for self-employed individuals, independent contractors, and sole proprietors who do not have employees. They would have received very small loans of about $21,000. That doesn't apply here because we're mortgage banks, so I'm not going to spend any more time on that one. Criteria number two is the one that could be relevant for mortgage banks. I'll get into why. So generally, this applies to borrowers who do not have a salary and hourly wage reduction, nor a full-time equivalency reduction. For the salary and hourly wage reduction, that means no employee was reduced in excess of 25% in the covered period as compared to the first 3 months of 2020. Next, there must not have been a reduction in headcount between January 1st, 2020 and the end of the borrower's covered period, after adjusting for any exceptions, which we'll expand on later. Therefore, borrowers who were able to pay their employees at the same level and keep all their employees would most likely be eligible for that 3508EZ. This becomes a little tricky for mortgage banks, however, given some of the compensation structures that we've seen. For one of the applications that we've prepared, the borrower had several employees who work on commissions. So just in speaking with people from the bank, you would think that they haven't reduced anyone's salary and they haven't reduced headcount because business has been good and they're in a position where they're adding people and not laying people off. However, there are some employees that, completely unrelated to COVID, received a large commission in the first 3 months of the year, and then for whatever reason have not received commission checks at that same level throughout their covered period. So since the form asks just for cash compensation for employees and it doesn't adjust for, say, if you have a compensation structure where you are commission-based, the timing of the commissions may effectively result in a salary or hourly wage reduction. Unless there's additional guidance on this specific situation, we have to take the stance that technically this does count as a reduction in salary, which would then exclude the borrower from filling out Form 3508EZ. However, there are scenarios where even though it counts as a salary and hourly wage reduction, it won't reduce your loan forgiveness. And then criteria number 3 is similar to criteria 2 with a slight difference. The first facet is the same, so there's no salary or hourly wage reduction. And then the second facet is that the borrower was unable to operate at the same level during the covered period in compliance with CDC, OSHA, or the Secretary of Health guidelines. The rationale is that you're not penalized for reduced operations due to a regulatory guidance negatively impacting your ability to do so. But as I mentioned earlier, we don't anticipate mortgage banks being able to fall into this category, just given the nature of the market right now. Here on this slide, we see the top portion of the Form 3508EZ and the information that borrowers will need to disclose. You will need your loan info, such as the loan number, loan amount, and loan disbursement date. It also asks for the number of employees at time of loan application and at the time of loan forgiveness. Note that this is total employees and not full-time equivalents, so this doesn't get factored into loan forgiveness, but it's more informational just for your lender. It also asks for your pay schedule, so weekly, bi-weekly, twice a month, etc. And this is where you would determine if you're doing the covered period or the alternative covered period. Borrowers will need to disclose if they receive over $2 million combined with their affiliates. The SBA and the Treasury have asserted that all loans over $2 million will be subject to an audit. They have conversely indicated that loans under $2 million will be deemed to have made the required certification concerning the necessity of the loan request in good faith. However, we still believe it to be best practice to document the loan and expenditures as much as possible. This is in case you have any audits down the road. Here we see how the forgiveness is calculated on the EZ form. So up top you have your payroll costs and non-payroll costs, which are then totaled in line 5. This is one of your forgiveness limits. Remember, there are 3. Then we see the other 2 limits, your original loan amount and your payroll cost divided by 60% as discussed earlier. Line 8 would take the smallest of these 3 as your ultimate forgiveness amount. That sums up the short form and demonstrates the mechanics of the form without any modifications for the salary and hourly wage reduction and the full-time equivalency reductions. Next, we'll discuss the Form 3508 long form. This is the form to be filled out by borrowers who cannot use Form 3508EZ as we discussed earlier. You would fill this out if you had a reduction in salary and wages or a reduction in headcount, and you were able to operate throughout the covered period. This form adds PPP Schedule A and PPP Schedule A worksheet as additional parts of the form to be completed. Let's first discuss the PPP Schedule A worksheet. This is where you schedule out the cash compensation, full-time equivalency, and salary and hourly wage reduction for each employee during the covered period. There are 2 tables. Table 1 is for all employees whose annualized 2019 compensation was $100,000 or less, or they were not employed in 2019 by the borrower. Table 2 is for employees whose annualized 2019 compensation was more than $100,000. There is no salary or hourly wage reduction for any employee in Table 2. Therefore, if an employee was compensated at an annualized rate greater than $100,000 in 2019, they are not subject to a salary or hourly wage reduction. So here on this slide, we see the Schedule A worksheet as it appears on the form. You will need to list each employer's name and employee identifier, which in most cases will be their social security number. Then the form asks for the cash compensation to be paid to each employee. This will be the actual cash compensation paid, not annualized, and capped at that $46,154 limit for each employee. Remember that the $46,154 is the 24-week equivalent of $100,000 for the year. The next column is the average full-time equivalency, which will be used in the FTE reduction quotient, which we'll get into later and we'll go through examples. And the last column is the salary and hourly wage reduction for each employee, but only for those employees who are listed in Table 1, because remember, employees in Table 2 are not subject to that reduction. The two major forgiveness factors that could reduce your loan forgiveness include the aforementioned drop in salaries and drop in employee headcount. The loan forgiveness forms formally refer to the drop in employee salary as the salary and hourly wage reduction, and it refers to the drop in employee headcount as the full-time equivalency reduction. Let's start by looking at the salary and hourly wage reduction. Borrowers who reduced employee pay in excess of 25% may have their loan forgiveness reduced. The borrower compares each employee's annualized salary during the covered period to their annualized salary during the period of January 1st, 2020 through March 31st, 2020. Any reduction beyond 25% would be a dollar-for-dollar reduction of potential loan forgiveness. It is important to note that reductions less than 25% do not count against the borrower's loan forgiveness. This calculation is done for each individual employee, which can certainly become time-consuming based on the quality of your payroll reports. If you have a bunch of employees and you do not have your payroll reports in an easily workable format like Excel, you probably want to start exploring how to make that happen in advance of having to go through this process. It might be worth reaching out to your payroll company to see if they have any reports that they can export to either Excel or some other easily manipulatable format, and this will be vital towards what I'm about to show you. There are 3 steps to determine loan forgiveness related to a reduction in salaries and hourly wages. Step 1, determine if an employee's pay was reduced beyond that 25% threshold. Step 2, determine if the salary and hourly wage reduction safe harbor was or will be met. And step 3, determine if there is a salary or hourly wage reduction to be made to your loan forgiveness. Step 1, determine if pay was reduced more than 25%. Here we have 4 employees listed with their average covered period salary next to their average salary for the first 3 months of the year, which are both then annualized. The rule is if the annualized covered period salary is less than 75% of the first 3 months' salary annualized, then you may have a loan forgiveness reduction. In the rightmost column, we see each employee's covered period salary as a percentage of their salary for the first 3 months. Employees A, B, and C are all below that 75% mark, which means that their salary was reduced in excess of 25%. They all proceed to step 2. Since employee D was still compensated at 95% of their original salary, they are treated as if there was no reduction and there is no additional work to be done for that employee. Step 2, determine if the employee meets the safe harbor. A couple of slides ago, I mentioned that the PPP Flexibility Act allows for borrowers to restore salaries by December 31st, 2020, and if they do, then there is no loan forgiveness reduction. This is the salary and hourly wage reduction safe harbor. Even if a borrower reduces an employee's salary beyond 25% during the covered period as compared to the first 3 months of 2020, there is still an opportunity to avoid forgiveness reduction. If an employee's annualized salary is reduced from the pay period including February 15, 2020, when compared to the pay period including April 26th, then they have the opportunity to utilize the safe harbor. The borrower can subsequently restore the salary to the pre-pandemic February 15th level by December 31st, 2020 at no penalty. This is calculated for each employee. There is no forgiveness reduction for any employee who meets this criteria. To summarize, if an employee's salary was dropped in the early days of the pandemic as compared to pre-pandemic levels, then the borrower has until December 31st, 2020 to restore their salary to that pre-pandemic level. The takeaways are: one, that borrowers have until the end of the covered period to ensure that employees' average annualized salaries have not dropped past that 25% mark. And two, if they have dropped more than 25%, that borrowers can restore the salaries to pre-pandemic levels prior to the end of the year to avoid loan forgiveness reduction. This is one of the reasons I say that it's so important to stay on top of these calculations in real time, because there's still an opportunity to adjust in case you're not currently achieving that maximum forgiveness amount. So now we continue with our example. Employee A started with a salary of $85,000, which was then reduced to $50,000, but then by the end of the year was restored to $80,000. So they had their salary restored. You can see it increased after that April 26th number, but it wasn't all the way back to the pre-pandemic $85,000. Therefore, they don't satisfy the safe harbor. You have to get all the way back. Employee B had an average salary of $90,000 pre-pandemic, and they were reduced to $65,000 by April 26th. They saw their salary fall further by the time of the loan application or the end of the year, whichever is sooner. So they clearly do not satisfy the safe harbor and will move to step 3. Employee C started with 75. They were reduced to 40, but then by the loan submission, their salary was back up to $78,000. This exceeds their original salary, so they satisfy the safe harbor because remember, you have to either restore it to the exact amount or you can exceed it. Now, step 3 is to determine the salary and hourly wage reduction. Employees A and B both did not satisfy the safe harbor, so they moved to step 3. We calculate their wage reduction floor, which is their starting salary multiplied by 75%, because remember, we're looking to see the reduction in excess of that amount. Anything reduced in excess of this floor would be the salary and hourly wage reduction. So employee A started at $85,000. 75% of that number would be $63,750. The borrower is penalized for any reduction below $63,750. The same goes for employee B. So we'll take these amounts and you subtract the average covered period salary from the wage reduction floor to get to our salary and hourly wage reduction. The excess reduction is the difference between the wage reduction floor and the covered period salary. For employee A, that would be the $63,750 minus their covered period salary of $50,000, which equals the $13,750 you see in that middle column. And we do the same math for employee B, which comes out to $2,500. Now, since these are annualized numbers, we need to prorate them just for that 24-week covered period. So what you do is you take the total and you multiply it by 24 50-seconds, which is 24 weeks out of a 52-week year. And then you total those amounts, and that's your salary and hourly wage reduction. So moving forward, we have 2 scenarios, one where your reduction will reduce your loan forgiveness and one where it won't. And we're going to start with the one where it won't. So this is 3508, the long form, because you can see it adds a couple of extra lines. It adds your line 5 total salary and hourly wage reduction, and it adds your line 7 FTE reduction quotient. For this example, we're going to assume the reduction quotient is 1, which means there was no reduction because we haven't explained that part of it yet. But let's assume you paid cash compensation of $1.5 million for the period, and after doing the whole long form, you determine that you have a total salary reduction of $75,000. This would mean you're eligible for loan forgiveness of the $1.5 million less the $75,000 because your potential amount is reduced by the reduction, which leaves you with $1,425,000 in line 8. And what you do with that is it limits your forgiveness to that amount. You may be in a position, though, where your total spend far exceeds your original loan amount to the point that the reduction is virtually irrelevant. If you're a business that didn't really reduce payroll during your covered period, this is a very real possibility. Recall that businesses were eligible to receive loans equal to 2.5 months of payroll expenses. Now, under the new rules, you can spend those funds on 24 weeks of payroll, which is almost 6 months. So as you see here, you can be in a position where your loan was much less than you paid in payroll during the period. So in this example, the borrower has a loan of $675,000, and you could conceivably have paid much more than that during the period, which is what we're showing in this example here. So even though you have the reduction of $75,000, you're still well beyond that PPP loan amount. And since your forgiveness is the lesser of those three amounts, you're still covered even though you didn't necessarily have your employees back at that same salary level and you were penalized, but it ultimately doesn't end up mattering. Now, scenario 2, let's look at the same thing, except now we will see what happens when there is a forgiveness reduction due to a drop in salaries. So assume the same facts as earlier, except now the borrower spent only $675,000 on payroll costs. This is equal to the loan amount they received. However, now the salary and hourly wage reduction results in line 8 being the smallest amount, which ultimately limits their forgiveness. So you can see where you have payroll costs of $675,000, but then you have to reduce it by your salary and hourly wage reduction, which brings you down to $600,000. So if you look down now under potential forgiveness amounts, that makes line 8, your modified total, the least there. So then you bring that down to line 11, and that's your final forgiveness amount. And then you would be subject to paying back whatever is the delta between your PPP loan amount and your forgiveness amount, which in this case would be $75,000. So that just about sums up salary and hourly wage reduction. And I'm going to now move forward to the full-time equivalency reduction. The second forgiveness factor that we consider is the full-time equivalency reduction. And this is what we refer to when we say the drop in headcount. One of the intentions of the PPP loan program was to keep as many people employed as possible. The forgiveness application compares the borrower's headcount to various reference periods to ensure that the headcount has remained at those pre-pandemic levels. If the headcount is lower during the covered period, it may result in forgiveness reduction. A full-time equivalent is any employee who works 40 hours per week or more. This is measured by taking the number of hours worked per week per employee and dividing by 40. There's a maximum of 1 full-time equivalent per employee, so any number of hours worked in excess of 40 hours per week still only counts as 1 FTE for that employee. Full-time equivalency is calculated by taking the weekly hours and dividing by 40, like I mentioned, and you round to the nearest tenth. So part-time workers would be less than 1. But there's also a simplified method that allows borrowers to use 1.0 as the full-time equivalent for employees working 40 hours or more, and 0.5 for any employees who are working less than 40 hours. The borrower then totals up the full-time equivalency for each employee to arrive at the total average full-time equivalency for the period. As I mentioned, loan forgiveness is reduced if the borrower's average full-time equivalency during the covered period is less than that during their chosen reference period. The borrower has, in most cases, 2 options to choose for their reference period and can pick the one that is most beneficial for them. Reference period number 1 is February 15th through June 30th, 2019. And reference period number 2 is January 1st through February 29th, 2020. There is a third reference period for seasonal employees, which is any 12-week period between May 1st and September 15th, 2019. However, we don't expect any mortgage banks to be considered a seasonal employer, so you're really limited to the 2 options. The full-time equivalency reduction quotient is calculated by dividing your covered period FTE by your reference period FTE. This is effectively the percentage of your headcount you were able to sustain during your covered period as compared to your reference period. If you remember back to the 3 limits for loan forgiveness, the third one is the sum of your covered costs reduced by salary reductions and drops in headcount. So this is what we mean by a drop in headcount reducing loan forgiveness. The otherwise forgivable expenses are multiplied by this FTE reduction quotient to determine your forgiveness. For example, if you're operating at a headcount equal to 80% of your reference period headcount, then the sum of your covered costs will be multiplied by that 80% to arrive at your forgiveness. The goal is to achieve an FTE quotient of 1.0 since that will result in no loss of forgiveness due to employee headcount. However, like you saw earlier, even if your FTE quotient is below 1, that doesn't automatically mean that you're going to miss out on full loan forgiveness, which I'll demonstrate later on with some screenshots of the form. So here on this slide, we see a sample full-time equivalency calculation for 4 employees, and this is for the reference period. Employee A was averaging 55 hours, so they count as 1.0 because anyone over 40 is still 1. This is the same as employees B and C, who are at 40 hours even. Employee D was a part-time employee working 30 hours, which is 0.8 FTE because it's 75%, but you round to the nearest tenth. So the total for your 4 employees is an average of 3.8 FTE for the reference period. And then on the column all the way to the right, you see what the calculation would be if it was under the simplified method, which I anticipate a lot of people will opt to do. Next, we see the same calculation, except this is for the covered period this time. Employee A saved the same amount, so they're at 55, and they still count for 1.0. Employee B, same thing, they're at 40 hours, they're 1.0. But now employee C had their hours reduced to 28 per week, which is now only 0.7 FTE, and employee D was reduced to 5 hours per week on average during the covered period, which translates to 0.1. This results in a total average covered period FTE of 2.8. But under the simplified method, as you see again in the column all the way to the right, that would be 3.0 because C and D both count for 0.5, even though one is 0.7 and one is 0.1. So this is to demonstrate that under the simplified method, sometimes you'll come in a little higher, sometimes you'll come in a little lower, but it does help when you're doing the calculation because if you can just classify people as part-time and full-time, then it'll save you having to dig through and get their weekly hours throughout the entire period. So here's the part of the form where you would then calculate the FTE reduction quotient. So from our example, our simplified reference period FTE was 3.5. That would go on line 11. Our total average FTE refers to our full-time equivalency during the covered period, and this goes on line 12, which in our case was 3.0. Then line 13 divides the covered period FTE by the reference period FTE, which in this case, we see an FTE reduction quotient of 0.857. As I mentioned earlier, there are some exceptions when it comes to figuring out your full-time equivalency. Some things are simply out of the borrower's hands when it comes to employee headcount, so the exceptions are included in order to make the forgiveness a little more fair towards the borrowers. Employers would not be penalized for certain employees who do not return to work. Borrowers can exclude the following people from their FTE calculations. Number 1, an employee who was employed at February 15th and who refused a written offer to return to work. Number 2, an employee who was employed at February 15, 2020, and who refused a written offer to have their hours restored at the prior salary or wage. Number 3 is an employer who is unable to hire qualified employees before December 31st, 2020. And number 4 is employees who were fired for cause, voluntarily resigned, or requested a reduction in hours. Importantly, these exceptions apply only if that specific position was not filled by a new employee. The key here is to document as much as possible. You won't have to submit the written offers with the loan application, but in the case you get audited, you want to make sure you have as much evidence for these exceptions as possible. There are safe harbors for the FTE reduction similar to the wage reduction. Safe harbor number 1 applies to those businesses who cannot operate at the same level from February 15th through the end of the covered period. This would have to coincide with certain guidance issued by the Secretary of Health and Human Services, Director of the CDC, or OSHA. The shutdowns could be related to COVID-19 sanitation, social distancing, and other worker or customer safety requirements. Businesses such as mortgage banks may have a hard time claiming this first safe harbor since the level of operation most likely did not decrease and we didn't see widespread layoffs. Instead, a lot of them are seeing an uptick in business given the current market climate, so this one might be a little harder case to make. FTE reduction safe harbor number 2 is very similar to the salary and wage reduction safe harbor we discussed earlier. However, you just replace wages with average headcount. If the borrower reduced their headcount between February 15th and April 26, 2020, then they have until December 31st, 2020, or the date they submit their loan application, whichever is sooner, in order to restore that headcount. If a borrower reduces and then restores their headcount, then there is no reduction of loan forgiveness stemming from the full-time equivalencies because the safe harbor will be met. So now let's go into 2 scenarios similar to the 2 I presented earlier. And the first one we're going to look at is you had a headcount reduction along with a salary and hourly wage reduction, but it does not result in a forgiveness reduction. So we expand on our example from earlier. You have the payroll cost of $1.5 million, which is then reduced by the $75,000 salary and hourly wage reduction from earlier to arrive at a line 6 amount of $1,425,000, the same as before. Line 7 now, though, carries our FTE reduction quotient from Schedule A, which we calculated earlier. So we see there now the 0.857 that we just went over. You multiply the line 6 amount by the FTE reduction quotient, which gives you the modified total, which is now just over 1.2 million. We see here that the modified and limited amount is still much greater than the original loan amount of $675,000. This is the position that a lot of mortgage banks may find themselves in, where they did reduce some salary just given the nature of the compensation. Maybe they did have a headcount reduction, maybe not, case by case, but since you have the 6 months to pay out almost 6 months to pay out your salaries, and you only got a loan amount for 2.5 months, we anticipate many people will completely blow away their loan amounts with how much they paid in salaries. But just for your information, here's scenario number 2, which is a headcount reduction and a salary reduction, which also results in forgiveness reduction. So we use our scenario 2 from earlier, which is the payroll cost of $675,000 reduced by $75K, and you get line 6 of $600,000. Then we use the same FTE reduction quotient, which gives us a modified total of $514,200. This $514,000 then represents your upper limit because remember line 11, total forgiveness, is the smallest of the 3 lines above it. So now your modified total drops below your PPP loan amount, and the maximum forgiveness that you'd be eligible for is $514,200. And the difference between those 2 numbers is what you would have to then pay back as a loan. Since we have a mortgage banking audience today, let's look at how the PPP loan forgiveness guidelines may apply to your company. As we mentioned earlier, many of the banks we work with have seen an increase in business and subsequently an increase in employee headcounts. This fact, combined with the increased period in which borrowers can pay out payroll expenses, means that most mortgage banks should be able to achieve full loan forgiveness. With my example earlier, I mentioned that commissioned employees are one of the reasons that we have seen where borrowers may be ineligible for that 3508 EZ. You should make sure to analyze your situation, but remember that even though you're not filing the EZ, you still could be eligible for the full loan forgiveness amount. And then another point I wanted to mention is that the EIDL advance that some companies received are not forgivable. If you remember back to March and April, part of the CARES Act provided that the economic injury disaster loan advances of up to $10,000 per company. That factors into your forgiveness. It won't be forgiven and you can't outspend that. So that is an amount that you will have to pay back if you got it. So now it's time to talk about some takeaways and steps you can take today to help yourself out down the line. The first step is you can gather up all your documentation to support your headcount figures, salaries, and other covered expenses. You will need to use these to do the calculations eventually. Given that many borrowers have now had the loan for months and have spent most, if not all, of the funds, this is certainly something you can begin doing as soon as possible. On the next 2 slides, I'll have lists of documentation as a good start that you can use to then start gathering what you need. Another important aspect is to ensure your original loan amount is correct. there was a ton of confusion around which payroll expenses could be included in the original loan calculation. One of our clients received a larger loan than they were entitled to. So back when all this craziness was happening, no one was sure of exactly which expenses could be included and which couldn't. For example, their lender allowed them to consider employer-paid FICA in their loan amount. This is incorrect, and upon audit, they will be required to pay this portion back. So we're advising our clients to get out ahead of this in order to prevent future headaches and unexpected reductions of loan forgiveness, which would then require you to pay that amount back. As I mentioned earlier, many covered periods are still open. Look at your expenses, look at your headcounts, look at your payroll levels, look at those now to avoid loan forgiveness reduction later. If you catch any deficiencies now, you still have time to correct the issue and achieve full loan forgiveness. Once the covered period closes, it becomes much more difficult to do so. And once those safe harbors at December 31st pass, it becomes almost impossible. So these are the payroll documents. I'll just touch on these very quickly because we're getting a little short on time. So you'll have the slide deck after this, so you can use these, but you want bank accounts, tax filings, receipts for your health insurance and retirement plans, 2019 compensation for each employee. And then this is the headcount documents to gather just to substantiate your headcount levels at each of those reference periods that I had mentioned. And then you want to make sure you document any job offers, refusals, firings for cause, and voluntary resignations. So what are your next steps? Next steps, you fill out the loan and you would submit it to your lender. The lender is the one who will then make the decision on your loan application and send it to the SBA. Any part of your loan that is not forgiven will be due in 10 months from the end of your covered period. If your covered period ended today, you would have until the end of July 2021 to have your loan forgiven. Interest accrues on the non-forgiven portion of the loan starting on the day the loan was dispersed. However, accrued interest on the forgiven part of the loan will also be forgiven. If the entire loan is forgiven, there's no interest due. Once you submit your loan forgiveness application, the lender has 60 days to issue a forgiveness decision. And now that wraps up my portion, and I'll hand it back over to Santo.
Thanks, Frank. As you can tell, there's a lot of information there, and I know we're running a little bit out of time. I'll run through this, but any questions that we get, we have our email addresses in our bio. Certainly, we will answer everyone's email to any questions if we don't get to field any. So now we're going to talk about the accounting treatment of the PPP loan. How does the borrower account for the proceeds from the PPP loan for financial statement purposes? Since the legal form of the PPP loan is debt, it will always be appropriate for an entity that receives a loan to account for it as debt under Accounting Standards Codification 470, regardless of whether the entity expects the loan to be forgiven. However, if the entity expects to meet the PPP's eligibility and loan forgiveness criteria, it may recognize income as it incurs the qualified expenses under ASC 958-605 and can elect to account for the proceeds as a government grant. This also is discussed in IAS International Accounting Standards 20. It is recommended that the company shall first consider accounting principles for a similar transaction or events within a source of authoritative U.S. GAAP for that entity, and then consider non-authoritative guidance from other sources. That being said, accounting for the PPP loan for a business entity might be best done by referring to the not-for-profit guidance in ASC 958. If the business's expectations change after reassessing the forgiveness provisions and your company's compliance or lack of with those provisions, you would have to reverse previously recognized income in the statement of operations. Since the industry is having a record year and are good with all of the financial and regulatory covenants, we have suggested to our clients to treat the PPP loan as debt, although they may expect it to be forgiven, and in the following year pick up that income as debt extinguishment in order to better manage their P&L. Potential tax consequences. The PPP loan receipt is not taxable income. However, expenses that factor into forgiveness are currently not deductible according to IRS Rule 2020-32 pursuant to Code Section 265. Effectively, PPP forgiveness is taxable income. This could possibly change, so we need more guidance on it. The HEROES Act, which was passed in the House, would reverse the IRS rule, meaning that the expenses that were paid could be tax deductible. It may take until the election or latter for additional guidance, but certainly we need to pay attention to it. The receipt of the PPP funds does not count as taxable income. However, today, the IRS asserts that expenses used to calculate the loan forgiveness are not deductible on the tax return. This disallowance of the expenses effectively makes the PPP loan proceeds taxable, and many organizations, including the AICPA, are calling on Congress to issue further guidance to clarify that these expenses would still be deductible even if the proceeds are not included in taxable income, under the rationale that these loans were clearly intended to provide relief in the form of a tax benefit. There is even legislation that has passed in the House under the HEROES Act that would reverse the IRS rule on this matter. However, given the current political climate, we're not holding our breath on any additional guidance until after the election. It's important to note there are contradictions amongst peers that IRS Section 265 cannot be held to apply to this type of discharge of indebtedness, i.e. loan forgiveness, but just want to make a note of it. So basically, we should hold off in filing these forgiveness applications as long as possible, because as you're going to see, there are a lot of when to strategically file. Congress may change the rules. The rules can, become better or worse. The one thing that it's important to note is that you are held to the rules in place on the date that you file. So whatever rules are in place on the date you file, your forgiveness application is basically what you're held to at that time. Should anything change after that, you were held to the rules that were filed at the time you submitted your forgiveness application. Forgiveness may not be granted until 2021, which leads to questions. Do we deduct now and amend later? Do we deduct in 2020 and recognize income in 2021? Do we file for an extension and hope for guidance? So depending on what you choose can make things challenging because a lot of estimated payments would be due on January 15, 2021, especially on the pass-through entities for the individuals that are subject to the income on those entities. If you decide to deduct the expenses in 2020, you should consider filing IRS Form 8275, which is a disclosure statement with your tax return, which will include a disclosure of items or positions that are not otherwise adequately disclosed on a tax return, so as to avoid penalties in case the IRS does audit later and they reverse the decision. So with that said, that pretty much wraps up our session. I'm not sure if there's any time for any Q&A, Jordan, but if not, as I said, we will gladly help anyone that needs any help with the applications, and any questions, we'll certainly be able to email them to us, and we'll certainly be able to answer all of them as quick as we can.
Yeah, we do have a few questions. Would you gentlemen mind sticking around just for a few more minutes to answer them?
We'll do our best.
Okay, so our first question is if for other reasons it is tax advantageous to claim money that was spent on the allowable 40% of the other items first, is there any guidance or anything saying you have to allocate it to payroll first on the application?
No, there's nothing that says you have to allocate it to payroll first. You can kind of fill the form out under the current guidance. You can fill the form out that, the way that you see fit. So just in my examples, I showed just payroll because that's the one that they're going to focus on the most, and that's going to be your biggest expense. But if for your tax scenarios, if for whatever reason you want to use those expenses elsewhere and not have them disallowed, then you can fill out the expenses whichever way you need to.
Okay. Then I have a question that says, we are on a bi-monthly payroll. We received a loan. We received the loan on April 10th. Would we need to prorate 4/15/2020 payroll? My understanding was paid or incurred after the loan.
Yeah, so that is correct. It's paid or incurred. So if you incurred payroll prior to receiving the PPP funds, and then you received the funds after that date, and the payroll was paid after you received the PPP funds, the week before you received the funds would be included in part of the computation and eligible as payroll expenses.
Okay. And finally, I have the question of, how do you handle calculations if an employee decided to quit during the 24-week covered period, not terminated by the company?
So a voluntary resignation is one of the exceptions that we went over. So if they quit, say your FTE for your reference period was 7, and then for your covered period it was 6. If that person quit and you did not fill that specific role, that exception is counted in your FTE calculation for your covered period. So it would be 6 during the period plus 1 exception brings you to 7, and you wouldn't have a reduction if that was the only person that was taken off of your head count.
Okay, and it looks like that's the end of our questions. Gentlemen, did you have anything else you wanted to touch on before we wrap up?
No, not really. I think the best thing is that we can suggest is be prepared, especially the bankers that received over $2 million. Document that 14-day rule in case your lender is aware of the rule and questions the rule, as well as all the industry publications that had many articles of what occurred in the industry in March, April, and May. So to be audit ready, I think proactive in this case is going to ensure the best success.
Well, thank you, gentlemen, so much for sharing your knowledge with us today, and thank you, everyone, for tuning in. Next week, we are actually going to conclude the Industry Insights webinar series. Today was supposed to be the last webinar, but since we had such a good turnout, we've decided to add another one. And that presentation will be with Henry Chavez of Spiegel Accountancy Corp. He is going to be addressing the financial reporting that falls under the responsibility of the finance department and what falls under the auditor. So stay tuned for an email to register for that, but you can register online at our website as well. And also look out for the email with today's recording as well as the slides. Thanks, everyone. Have a wonderful afternoon, and we'll see you soon.
Thank you. Thanks very much, Jordan. Take care.